Okay traders, so here we are on our charts. Before I give you the particulars of the strategy, let's review the indicator that we will use throughout the backtesting process, and let me show you how I use them. By the way, if you haven't watched the chart setup video, I posted the link below. Let's start with the Ichimoku indicator. If you remember, from the chart setup video, this is my settings for Ichimoku indicator. The red line is the Tenkan Sen. The Dodger blue line is the Kijun Sen. Chico span is set to transparent because we will not be using it. This royal blue line is the Senko span A, and this crimson colored line is the Senko span B. In Japanese, this is called Kumo, which means cloud in English, simply because it looks like a cloud. Now, if the Senko span A is above the Senko span B, it is called a bullish Kumo. And if the Senko span B is above the Senko span A, it is called a bearish Kumo. And by simply looking at the current price level relative to the Ichimoku, I can easily identify what the current trend is, and what my bias will be. If the current market price level is trading above the Kumo, and not touching the Kumo, and if the Tenkan Sen is above the Kijun Sen, and if we have a bullish Kumo, the trend is bullish, and uptrending, and our bias is to buy or go long the market. And we will only be looking for a buy trade. Next, let's review the average true range indicator. This is my settings for this indicator. This Dodger blue line on this separate panel is the average true range indicator. Its only job is to measure market volatility of the set period. Now, if you focus your attention on the upper right-hand corner of the screen, that is our data window. At the bottom of data window, we can find the ATR value for each candle that I hover my mouse cursor to. And these value will be used to calculate our stop-loss price. More explanation about these later. Now, let's proceed with the rules of the strategy. Remember, from our trading psychology video, we talked about the 7 Principles of Consistency by Mark Douglas. And the first process in our consistency principle is to objectively identify our edge, and we will train our mind to trade exactly like that. This is a trend following strategy. So the first thing that we need to know, every time we go on to chart and start looking for a trade, is to know what is the current market trend, or is the market in consolidation or ranging, and what will be our bias for the moment. Step 1. Identify the current market condition using the Ichimoku indicator, and decide what will be our bias. Keep in mind, if the market is touching the Kumo or is trading inside the Kumo, that is our definition of a ranging and consolidating market condition. If that is the case, we will not look for a trade. This is our step-by-step process in identifying the trend. If the current market price level is trading above a bullish Kumo, and not touching the Kumo below, and if the Tenkan Sen is above the Kijun Sen, and if we have a bullish Kumo, the trend is up and bullish. Our bias is to buy or go long the market. We will look for a good price level to buy the market. So, step number 1, check. Step 2. We need to see if the market recently created a series of new higher low and higher high, breaking above the initial high. This is a basic price movement to start a trend to the upside. Also, if you can remember, the basic principle that this strategy is based upon is that we want to buy a market that is already trending higher. A market that breaks up above a range or consolidating or an impulsive move above the Kumo is also valid. More example of these in our backtesting. Let's find out if the market is trending higher. And as you can see, the market is already trending higher. The initial low here, the initial high here, higher low here, and higher high here. Finally, breaking above our initial high. Step number 2, check. Now that we have a market that made a higher low and higher high above the bullish Kumo, and breaks above the initial high. For step 3, we need to see the market pullback and close below the Tenkan Sen. And from there, step 4, we will look for our entry signal, which I will discuss in detail in a moment. Let's proceed and wait for the market to pull back and close below the Tenkan Sen. Now that the market pulled back and closed below the Tenkan Sen, step 4, we will look for our entry signal, and that is a bullish inside bar. This is our entry signal. This is a bullish inside bar. The mother bar should be the swing low. Sometimes, the low of the mother bar and inside bar are equally the same, and that is still a valid signal. And as you can see, the low of the mother bar is lower than the low of the inside bar. Keep in mind, the Tenkan Sen should still be above the Kijun Sen. And we still have a bullish Kumo. And the current price level should not be touching the Kumo below. Back to the principle behind the strategy. The pullback is actually the short-term trend. Step 3 and Step 4 abide by our principle to go against the direction of the short-term trend, the pullback, and find an elegant entry in favor of the long-term trend, the inside bar. We now have a valid signal, and we will buy the market. But before that, this is a detailed explanation of a bullish inside bar candlestick pattern. I suggest that you pause the video and take the time to look at the specific rule of this candlestick pattern, because we will be using the same pattern throughout the backtesting process. Now that we have objectively identified our edge, and confirmed that we have a valid trade, based on our trading psychology video, the second principle of consistency that we must adhere to is to predefine our risk. Now, we don't know if this trend will persist and continue to go up and break the higher high. No one knows, we only have probability on our side. We might be wrong on our speculation, and instead, the market pushed the price back down. We need to protect our capital, and the next thing we need to do is to calculate our stop-loss price, or simply put, at what price level should the market move against me, that I will exit with a loss, and I will show you exactly how I do this. I am assuming that most of you are already advanced trader. In order to have a non-subjective approach to our stop-loss placement, I will explain this part, step by step, and for the benefit of beginner trader as well. Step 1. We need to find the highest average true range value between the mother bar and the inside bar. We will use the one with the higher ATR value. Now, focus your attention on our data window, while I hover my mouse on the candles. The inside bar has 0.0075 ATR. Mother bar has 0.0080 ATR, and is higher than the ATR of the inside bar. We will use the ATR of the mother bar. Let me just remove these drawings so that we can clearly see the charts. Step 2. Find the value of the swing low. We can do the same thing like finding the ATR by looking at our data window, while hovering our mouse cursor on the candle. Or we can use this built-in tool called Price Label, by simply pointing it at the low of the candle. As you can see, I have already used this tool to find the low of the mother bar, and the inside bar. Step 3. Subtract the value of the ATR from the swing low. In most cases the swing low is the mother bar. The low of the mother bar is 0.98910 minus 0.0080. And this will be our stop-loss price at 0.9811. We now have our stop-loss price. Next on the process is to actually predefine our risk, and decide how much of our equity, or our money, will be exposed to the market. It could be dollar base, or it could be percentage base. And in this particular strategy, I exposed 2% from my total equity. So, if I have $10,000 on my equity, the 2% of that will be $200. We can remove these drawings. Let's call our order pop-up window, and execute our order. We will be risking 2%. This is a buy order. Let's input our stop-loss price at 0.9811. And let's review our order one more time. The distance between our entry price to our stop-loss price is our risk, and that is equivalent to 2% of my total equity. If we are wrong in our speculation, and the market push the price to this level, we will automatically exit our trade losing only $200 of our money, plus the spreads and swaps. Many of you might think that 2% is quite big. But hear me out, this is how I personally execute this. I have a set limit of how much I expose to the market on a monthly basis, and I will not expose a total of 10% of my equity at any given time. But since this is a daily time frame, the transition from this trade to the next trade is quite long, and by the time the next trade appears, this current trade is already in break-even, or has been stopped out, or already running in profit, so the total exposure does not exceed 10%. If I trade the daily and the weekly chart, I will be risking 2% on main trade, and 3% if I will add to a position. For 4-hour chart time frame, I risk only 1%, and if I scalp the 1-minute or 5-minute chart time frame, I only risk 0.30% of my equity at any one trade. In this way, I have a very rigid money management strategy to protect my capital. More explanation about adding to position later. Now that we're on this trade, we're no longer technical analysts. As soon as we expose our money to the market, we are now risk managers, and we can do our job at best if we stay on that state of mind that is neutral, and in the moment. We did not set a profit target, and you will rarely see me set a target. Most of my strategy adhere to a different approach when it comes to profit taking. Yes, our consistency principles suggest that we pay ourselves as the market makes money available for us. We will abide by that principle, but in a totally non-conventional ways. During setting up our stop loss, I said that we don't know the outcome of this trade. At the level of one trade, the market cannot be predicted, and the outcome of each trade is random. But we protected our capital by limiting our loss through a stop-loss order, but we will never limit our chance to gain more profit. If we are right in our speculation, we will follow a different kind of mindset, a mindset that will be more conducive to a truly profitable trading, and this will revolutionize your trading. Let's proceed on the next step of the process. We did not set a profit target, but we will objectively set a profit projection scenario. We will use this Fibonacci retracement tool, but not to find retracement. Instead, we will use it to project where we move our stops, following the price whenever the market goes in favor of our direction. Let me just demonstrate so you can easily understand. We will plot this Fibonacci retracement tool from our open price to our stop-loss price. As you can see, this is not your normal level of this tool. I will explain about this in a moment. Back to plotting our tools. We need these price level at the exact numbers as our open price and stop-loss price, so we will edit the tool. I know this looks hard work, but this is a training of our trading discipline. So let's edit these number. Our open price at 0.99348. And our stop-loss price at 0.98110. And now, let's switch tab to levels. And as you can see, these levels are not the normal Fibonacci retracement levels, but instead, I customized these levels equivalent to twice our risk. I will elaborate on these in a moment. Now, we are on exact price level. Let's build our profit and loss scenario. Let me just zoom out so we can see more of our customized Fibonacci level. If the market continue to go down, and hit our stop-loss price, that's it. We're out of the game. Show's over. We have a small loss, and we will be defensive in our mindset. We will not move or hold on to this losing position. Simply put, we cut our loser short. But if we're right in our speculation, and the market continue to go up, we will follow the market until it stops us. Simply put, we will trail our stops using the Fibonacci retracement tools. This is what we will do. If the market proceeds to continue the trend, and hit this 300 level, we will move our stop loss slightly above the break-even line to pay for the swaps. Then, if the market continues to go to this 500 level, we will move our stop loss to 300 level at the exact number as indicated by the Fibonacci tool. Now, we are in profit, and we will continue to move our stop loss at every level whenever the market price hits the next level. Now, let me explain these Fibonacci levels in details. The distance for the open price to the stop loss price is our risk, and the distance from 300 level to the open price is equivalent to twice the risk. And the distance from 500 level to 300 level is also equivalent to twice the risk. Technically speaking, we're just trailing our stops, twice our risk behind the current market price level. In this way we will not be hit by some violent market swings, and we are letting our winners run and ride the trend. Let's proceed to the next part of the strategy, and that is, if an opportunity presents itself, we will add to our winning position. This part will revolutionize the way you see trading. If you want to make big money trading the market, you need to be able to get to the point where you can add to your winning position. This sounds simple, but I am telling you, this is difficult to execute, not physically but psychologically. Let's talk a little bit about the psychology behind this idea. Well, the main reason that this is difficult to execute mentally is because this idea is against human nature. It's only human nature to cut our winning position short and hold on to our losers. This human nature has something to do with the pain and pleasure principle. We tend to favor avoiding pain rather than gaining pleasure. I will focus more about this topic in future videos. Let me give you a scenario. If the market is moving in our direction, there's that part of our brain, or should I call it, the goblins in our heads, are screaming, the move is over and the market will soon retrace, so take your profit fast before it's gone. Sounds familiar? This is how the mind is wired to work, and our mind will do its duty to protect us from the pain of losing that profit. This is natural, and our mind will do its best to send us a message to bank that profit, because the pain of losing that profit is unbearable. And in the case of a losing position, our mind is telling us, I don't want the pain of losing money, so I am hoping that the market turns around, and so I am holding on to this trade until it does. This is essentially the wrong usage of fear and hope, which will be the topic in future videos. Let's go back on our strategy. Keep in mind that we will only add to our position if we have that first position established and running a profit. If it's not in profit, we will not add to our position. Let me just zoom back in. This is what we need to see, and what we will do. If the market goes in our favor, and push the price up, and breaks the most recent high, and closed above it with a strong bull candle. This strong bull candle should close above this high. We will add to our position with a very small stops, just 10 pips below the low of that candle, but this time, with a bigger position size of 3% of our equity. Remember, when we're right with our speculation, we will go against the human nature, and not take a limited profit, but instead, we will push our winners and go on offensive mode. But still, this is bound by our rigid rules, and money management procedure, like our stops, and how much risk we will expose to the market. Let's proceed, and see what happens next. Okay guys, the market continued the trend and pushed the price higher. And it seems that two things happened here that triggered our next move. As you can see, this is the most recent high. And the market breaks above, and closed above the high with this strong bull candle, indicating a strong momentum to the upside. And if you can also notice, the market hits the 300 level for our first position, and that means we can safely move our stop slightly above break-even, to pay for that swaps, which is now at -$8.64. First, let's focus on the part of being a risk manager for our first position. Our profit projection scenario says that if the price hit the 300 level, we will move our stop-loss price slightly above break-even, to pay for that swap. This will be our two-step process in moving our stop-loss to break-even, and then marking our next target. Step 1. Move our stop-loss slightly above break-even, while watching how much swaps do we currently have. As you can see, we now have -$8.64 of swaps, so we'll give it at least 70 points above our open price to pay for that. Next, let's adjust our chart to a smaller scale, so we can see our next target. And build a scenario for our next target, which is at level 500. If the market continued to push the price higher and hit the 500 level, we will move our stop loss at level 300 at the exact number indicated by Fibonacci. For step 2, we need to mark our next target using array from our drawing tools. And just like the Fibonacci, we want it to be at the exact price level, and we also need to give it a description that will remind us of our next move should the market proceed as we projected. The exact price of level 500 at 1.04300. And let's give it a description that says, for position 1, move the stop loss to level 300 if price action hits the level 500. Editing the description for this tool might seem an additional work, but let me tell you, this will be beneficial in the long run, especially if we have multiple trades open in one chart at the same time. Now, let's switch back our mindset to being a technical analyst for the position adding part of this strategy. Again, let's do an objective analysis if this signal is valid for us to add to our position. As you can see, this is the most recent high before the pullback. And the market breaks above and closed above that most recent high with a strong bull candle. And if you focus your attention on the trading panel below, you will see that our first position is now running a profit, making this signal valid and legible for us to add to our position. This time, with a very tight stops, just 10 pips below the low of that candle. And a 3% risk from our equity. Let's delete these drawings to clear our chart. And let's find out the low of this candle, and calculate where our stops will be, and then execute our order objectively. By using this price label tool, we can easily find the low of these candle. Let me just clear our calculator. The low of that candle, at 1.00730. Minus 10 pips, which is 0.0010. And this will be the stop-loss price for this position. Now, let's execute our order by pressing F2 to call the order panel. This will be a market order. Remember that, if the market goes in our favor, we will be offensive in our mindset, and we will risk 3% from our equity. Again, this is a buy order. And now, let's input our stop-loss price at 1.0063. I cannot emphasize this enough, but always review your order to avoid those little mistakes. And now that we're on this trade, and the risk is on, shift your mindset from the technical analyst perspective to the risk manager perspective. And next step, plotting our Fibonacci retracement tool to project our profit-taking scenario. And we want to be as objective as possible, so let's edit the tool at the exact price as our open price and stop-loss price. Our open price at 1.01838. And our stop-loss price at 1.00630. And now, let's build our profit and loss scenario for this position, and don't forget the proper mindset that is more conducive to a profitable trading. If the market price go back, and hit our stop loss, we will be defensive in our mindset, and cut it immediately. We will not move it or hold on to it, period. And if the market proceeds to go in our direction and hit the 300 level, we will move our stops slightly above the break-even line for the swaps. And now we are in offensive mode, and we will follow the price, and we will trail our stops just like the one we did with our first position. To avoid further confusion, let's review our charts. This Fibonacci level is for our first position, and this Fibonacci level is for our added position. Our first position is now at break-even line, and no risk expose and currently running a profit. The added position is still at risk. From this moment forward, I want you to be consciously aware of the thought process in your mind, especially the mental and emotional state that you are in for the moment. An example of these: are you in a state of mind that is fearful? Or are you confident? Maybe euphoric? And if possible, I want you to make a journal detailing the current state of mind that you are in. As you already know, this channel is more focused on the psychological side of trading, especially the thought process that goes on each trade, rather than the technical side of trading. That journal will be valuable at the end of this series, because you will personally assess those emotional and mental state, if you have used them correctly, or should I say, used them at the right time. I am confident that if you continue to watch these videos, and follow not just the rules of this strategy, but the psychological foundation behind this strategy, I can help make you a truly profitable and consistent trader. Let's proceed and see what happens next. Okay folks, it seems that both level has been hit. The level 300 for our second position was hit. The same is true for the level 500 of our first position. Now let's focus on the first position, and hover the mouse cursor on the ray line at the level 500 for the description. It says here, move the stop loss of the first position to level 300 if the price action hit the level 500. We can do that by double-clicking ticket number 1 on our trading panel, and navigate to modify order. Now, let's edit the stop loss price to what is indicated at the level 300. The level 300 at 1.01824, then click Modify Order. Next, let's update the new profit-taking scenario for the first position. If the market continue the trend, and hit the level 700, we will move our stops to level 500. Then, let's update the description and the price level of the ray line. The new description should go like this: move the stop loss to level 500 if the price action hit the level 700. And the new price level should be as indicated above, level 700 at 1.06776. Now, let's proceed on our added position. This was the scenario right after we opened our second position. If the market continue the trend, and hit level 300, we will move our stop loss line slightly above break-even line to pay for the swaps, which is now at -$8.58. Since we're just moving the stop at the break-even line, we can simply drag the stop loss line, and since the current swap is now at -$8.58, we can give it at least 82 points above. Finally, we need to update the new profit-taking scenario for this position. If the market continue to go up, and hit the level 500, we will move our stop loss line to level 300, at the exact price level as indicated by Fibonacci. We will also mark the level 500 with a ray line, just like what we did with the first position. Now, let's edit the description for this position. It goes like this: for position 2, move the stop loss to level 300 if the price action hit the level 500. Next, the price level should be 1.06670. In this strategy, if a new valid signal appear, from a technical analyst point of view, we will take that trade as long as it is in the same direction as the previous trades, even though there is a trade still running. If you can remember our job as an analyst, this is what qualifies a trending market. If the current market price is trading above the Kumo and not touching the Kumo below, and if the Tenkan Sen is above the Kijun Sen, and if we have a bullish Kumo, the market is in an uptrend and bullish. Our bias is to buy or go long the market. And as you can see, the market is continuously making a new high. Starting at the initial low here, initial high here, higher low here and higher high here. Breaking and closing above the initial high. From here, we will patiently wait for the market to pull back and close below the Tenkan Sen. And if an inside bar as our entry signal is printed, we will not hesitate to take this trade. Keep in mind that if the market begins to trend, we will follow that trend until the market stops us. In the market, nothing is really high and expensive enough, as well as nothing is really low and cheap enough. Let's proceed. It seems that the market started to pull back and printed an inside bar. Here is the inside bar, and as we can clearly see, the mother bar is also the swing low in this pullback. But let's be sure, in that pullback, in this case the mother bar, did it close below the Tenkan Sen? Let's hover the mouse cursor on this candle while looking at the data window, and check the closed of the mother bar, and compare it to the value of the Tenkan Sen. As you can see, the closed of this candle at 1.03550, while the Tenkan Sen value at 1.03540, indicating that this candle did not close below the Tenkan Sen, making this trade invalid as per the rules of this strategy. This is exactly the advantage of a system that has an objective and specific rules, making no room for guesswork, or thinking the validity of whether a trade is present or not. Let's continue. It seems like we just hit a level, but let's be sure, and let's increase the chart scale to clearly see what levels were hit. From what we can see on the chart, the market clearly hit the level 500 of the second position. And for the level 700 of the first position, we can objectively say that the market didn't push through. We have to be patient and wait until the market hit that level before we can move the stops. Now, let's focus our effort on the second position. Again, hover the mouse cursor on the ray line of the second position and check the description. And as you can see, the description says to move the stop loss to level 300 if the price action hit the level 500. Currently, this is where the stop loss for the second position. Now let's modify the stop loss for position 2. The new stop loss price should be at level 300, which is at 1.04254. And click Modify Order. Now, let's build the next scenario for this position, then update the ray line's description and price level. Let's adjust to a bigger scale so we can see the next level above the chart. If the market continued to push up and hit the level 700, we will move the stop loss to level 500. Now let's update the ray line description and price level. The new description should be, move the stop loss to level 500, if price action hit the level 700. And the new price level should be at level 700, and this price level at 1.09086. For those of you who might think that the process are monotonous and repetitious and boring, well, This is profitable trading. We have to focus on the process of trading until it is second nature to us, and we need to keep repeating the scenario in our head so that when it finally happens, we can objectively and perfectly execute what should be done. On the next candle, we can objectively say the market hit the 700 level for the first position. Now, let's do the same process we just did with the second position. First, read the description on the ray line. It says here to move the stop loss of position 1 to level 500 if price action hit level 700. Currently, this is where our stop loss for this position. Now let's modify this. The new stop loss price should be at level 500, at this price level of 1.04300. Then, click Modify Order. Now, let's build the next scenario for this position. If the market continue to push through level 900, we will move the stop loss to level 700. Then, let's edit the ray line's description and new price level. The new description should be this. For position 1, move the stop loss to level 700 if price action hit level 900. And the new price level should be at 1.09252. To avoid further confusion in the future, let's do a quick review of our current status. Position 1 is now running a profit, and the stops is currently at level 500. For position 2, it's also running a profit and the stops is currently at level 300. Now we don't have to worry about the swaps, because both positions are currently running a profit. Now, this is the part of trading where human flaw in behavior really emerge. And I want you to be conscious of your emotions. Just be aware of the thought process running in your mind. I can confidently say that the 80 to 90% of traders that are losing money consistently are currently thinking this scenario. Why don't we bank that profit before it's gone? Am I right? In the future videos, I will explain to you the proper usage of fear and hope. These two basic emotions in trading can be very useful if you know how to channel its proper usage. I will be brutally honest to you and say that it is against human nature. For the meantime, let's proceed with the trade. Let's just increase the scale to see more chart space above. Let's check if we hit a level. Not yet. How about this one? No, not yet. Okay, this time, both levels were hit by this big bearish candle. Level 900 of the first position were hit, and level 700 of the second position were also hit. Now, let's focus on the process, and do the position 1 first. The description for position 1 says, to move the stop loss to level 700 if price action hit level 900. Let's modify the stops of the first position. The new stop loss should be at level 700, and the price is 1.06776. The new profit-taking scenario should be this. If the market continue to push through level 1100, we will move the stops to level 900. We will now update the ray line's new description and new price level. And this should be, move the stop loss to level 900 if price action hit level 1100. Now, the new price level should be at level 1100, which is at 1.11728. And we're done with position 1. Now let's focus on position 2 with the same repetitive process. The description for position 2 suggests that we move the stop loss to level 500 if price action hit level 700. Let's modify the stop loss for position 2. The new level should be at level 500, and the price is 1.06670. Then, if you can remember, building the new profit-taking scenario. If the market continue the trend, and hit level 900, we will move the stop loss to level 700. After that, updating the ray line's new description, and new price level. The new description should be, move the stop loss to level 700 if price action hit the level 900. And the next price level should be at 1.11502. Okay, a while ago, when we did the technical analysis to validate if we are still in a trending market condition, and we have confirmed that the market is making a new higher high, higher low, breaking and closing above the initial high. Now, the market pulled back and closed below the Tenkan Sen, and as you can clearly see, the market printed a valid inside bar. But, there would be a problem with this signal. This mother bar is not the swing low for this move. The swing low is this bullish pin bar just 2 candles back, making this signal, as per the rules of the strategy, invalid. And we will not trade this invalid signal. Let's continue. Okay, now, the market moved to a deeper pullback, and hit both the stop loss for both positions, and we are taken out of a trade with a profit. And this is exactly what I meant by, we will follow the trend until the market stops us. And this would conclude the buy or long trade strategy rules. I also gave you some of the principles and psychology that this strategy is based upon. On the next video, we will talk about the sell or short trade strategy rules, and some psychology. The selling and the short side is just a mirror image of the buy trade, but we will objectively identify the rules of the strategy. Before I end this video, let's just do a quick summary of our trade, and you will begin to see the advantage of really letting your winners run. On the first position, we made 2R here, 2R here, and another 2R, giving us a total of 6R, multiplied by 2% for a total of 12%. For the second position, we made 2R here, and another 2R, for a total of 4R, multiplied by 3%, giving us a 12% gain on this position alone. I considered these one main trade, and one added position as a set of one trade. And by really letting your winners run, and adding to your position when you are proven right, to me, is more conducive to a truly profitable trading. Also, please take notice of the total deducted swap on the trading. If we're not careful, these swaps can take a chunk out of your profit. We will do more of these trade in the formal backtesting video, to prove to you that all we need to be a moneymaker in this business are these: a positive expectancy system with simple but objective rules, a rigid money management rules, a guiding thoughts or the principle behind the strategy, and finally, mastering your psychology, like the proper usage of fear and hope, letting your winners run, cutting your losers short, and adding to your winning position. If you like the video, give it a thumbs up, and consider subscribing to the channel. I'll see you on the next video. Thank you for watching.